Hello and welcome to Trading Hour on CNBC TV 18. I'm Ekta Batra and with me is Sumaira Bidi today. Well, it is turning out to be a day which is actually quite weak. We've recovered from the day's low nonetheless for the Nifty as well as for the mid-cap index, but currently still quite dismal. So the Nifty is down around 1% odd. We have the mid-cap index which is down around 1.3% and no prizes for guessing where exactly the weakness is stemming from. It is obviously what's taken place in terms of the global markets. If you just pull up what's happened with the Asian screen, you can see that the Nikkei too has reversed in terms of a couple of gains that they had seen earlier in the trading session. We obviously had a really dismal session for the US, though it was a shorter session on Monday, so that would be important to see in terms of how they trade. So overall, yes, weakness prevails for us despite the fact that Brent crude is at $50 per barrel, the lowest that we've seen in terms of prices all year round. A lot of stocks in focus that we will be discussing, the likes of HUL. A lot of the financials are weak today. So Yes Bank, India Bulls Housing Finance, all of these stocks at the low point of the day. And a couple of others such as Brigade, however, which is bucking the trend. So that stock up around 3.8%. No Christmas cheer, Sumaira?
Hi, Ekta. Yeah, exactly. There's no Christmas cheer. In fact, on Monday, we escaped some of that, global weakness. But today, it looks like we're going to make good, or rather make bad, that shortfall. Sudarshan Sakhani of S2 Analytics now joins in. Hi, Sudarshan. Good morning. You see incremental weakness in the market. On the index, how much lower do you think we could head?
Yeah, good morning again. This is really surprising. The markets have a track record of giving an end-of-day rally, end-of-year rally. But this time, that hasn't really happened. It is possible that the markets may again find some weakness. There is a possibility that 10,500 could be the next support level, the lower level for the market. But now there is no trade. So the Nifty and the Nifty Bank are best avoided for today. Shorting here is risky because your stops will be very tight and buying is not a good idea. There is no uptrend here. So stay away from the indices. Those who have short positions should keep a stop at 10,600 and try to take profits wherever they can. Don't take a new position. Individual stocks keep on offering opportunities. We have DLF, which is a short sell, and that's an intraday short. And similarly, Amara Raja Batteries is also an intraday short. Both should be considered as very weak stocks in an already weak market and therefore looking for more downside. There's also a buying opportunity that I can sense, and that is HDFC Bank. HDFC Bank is outperforming and is probably the reason why the markets may go up intraday for some time. So HDFC Bank is a buy and Amara Raja Batteries and DLF are short sells.
Okay, all right. So those are some stocks in focus as well. But Sudarshan, I just wanted to ask you before we get to Twitter queries, how would you be approaching the financial space? You spoke about HDFC Bank where you have a buy call. But otherwise, in terms of Yes, which is down 3.3%, and maybe a couple of others such as Bajaj Finance, 1.7% lower.
No, see, HDFC Bank is in a class of its own. It's been outperforming. But apart from that, it does appear that a lot of NBFCs are now bottoming out. So today you don't approach any of them because the markets are very chaotic. But eventually NBFCs can start building a base and give us buying opportunities. But that's for the future, not today.
Okay. We have a query that's come in from Sandeep Tripathi. He's written that he has shares of Infibeam at 52 rupees. He wants to know what he should do with it at the moment. Should he remain invested or book out? Sudarshan?
Oh, he should exit. He should simply sell and get out. There is no reason why you want to hold on to this stock. There are much better opportunities in mid-cap IT. Mindtree is an opportunity where you can switch and buy that. Hexaware, which is bottoming out, is a much better opportunity. So for this one, I would suggest exit and switch to some other IT company. I have named a few.
Okay. All right, Sudarshan, we're going to let you go on that note and we're going to join, we're going to obviously speak to you through the day to find out what exactly your take would be on the markets. In fact, there is a little bit more of an incremental recovery that we're seeing. So maybe there is some amount of buying on dips which is coming through for the Nifty at this point. Down around 87 odd points, 10,577 is where it's at. Some amount of recovery coming in for the mid caps as well, and a marginal improvement which has taken place in the advanced decline ratio. That chart should probably just come up. up for you. But let's focus on global developments then, and who else can we talk about but Trump? Trump, in fact, took to Twitter to criticize the Fed, saying that the central bank is the only problem, quote unquote, with the US economy. And in fact, Lata has been doing some amount of number crunching when it comes to the volatility index and the US markets, and she's here to tell us the fact that it's in fact gone up 400% this year itself, Lata.
Yeah. Well, actually, it's a series of uncertainties that the market has had to grapple with. It began, I mean, I'm putting Trump at the center of it because probably a lot of uncertainties originate from his style of functioning and the politics he has followed. You had the trade war uncertainties, and then you had, now you have the government shutdown uncertainty and a very big uncertainty if the Federal Reserve chief is going to be changed. We do not know where the rules stand because as of now, no Federal Reserve governor has been fired. But I just wanted to put on the table the amount of fear in the market. The higher this number, the more afraid people are, and therefore either they will buy protection or they will exit their positions. And that is why the most important index we have to track now in these troubled times is the volatility index. On Monday, the last day it traded, it rose from 30 to 36. That is a jump of 20% in a single day. Compare it to the week ago. Week ago, it was at 24. That's 5 trading days earlier. And therefore, compared to week ago, the fear index has gone up by 50% as we stand today. If you look at the month ago level, the fear index stood at 19. So from month ago levels, we have risen almost 100% in terms of the fear in the market. 6 months ago, it was 13. The rise over 6 months has been 276%. And Jan 1st, 2017, the fear index stood at a very low 9. From that index level, we have gone up 400%. So typically, when fear index goes up so much, the action on the part of market participants is to look either buy protection or, more importantly, more likely, take away whatever profit is left on the table, and that's what we have been witnessing. So very important to track the CBOE VIX, which is the US volatility index. As the mother market, that is a bit of an index for the entire world.
All right, Lata, thanks very much for putting that up for us. Pramod Gubbi, co-founder of Marcellus Investment Managers, also joins in now. Hi, Pramod. Good morning to you. Christmas was bad. New Year doesn't look to fare much better. Fear is high. Growth is low. What does the start of 2019 look like to you?
Well, I guess it's the beginning of the big unwind of the long cycle that we've seen in terms of easing of liquidity and the cost of money getting cheaper over the last 30 years. I think we've moved away from the last 10 years of quantitative easing into a quantitative tightening cycle, and that's clearly beginning to play out in the markets. Besides the short-term effects of the comments of the U.S. Treasury Secretary, which has clearly created a bit of confusion and chaos in the markets. If you step back and look at the longer-term trend, I think tightening of liquidity is here to stay, and that has ramifications on various asset classes across emerging markets and developed markets. So 2019 is going to be playing into this trend, which is, asset prices will have to react to the tightening of liquidity, and investors will have to be more selective in terms of their buying opportunities.
Take that point, Pramod, but, how bad can things get at all? There is already a lot of pressure from the US president to the Fed not to go ahead with its rate hiking cycle. We've never seen such a vicious attack on the Fed. But then on the other hand, Jerome Powell is only one member, and even if he is fired from governorship, the law is not very clear. He still remains a governor in the board of governors, and there are other governors whom the president can't touch. So what are you looking at in terms of possible Fed action? Have we seen the last of the hikes going by the political attack?
I guess there are two aspects here. One is the Fed funds rate itself, which now may see perhaps a couple of hikes into 2019, depending on how the economy reacts. Economy, from what we can see, is in a fairly sound footing, actually, thanks to all the rate cuts and the extra adrenaline that has been pumped into the economy. By and large, I don't think the Fed is on the wrong by tightening. But the bigger factor to watch out for is the QE retreat, the sort of bonds from the Fed's balance sheet that are allowed to roll off. We're looking at almost $50 billion a month, and that's a lot of money being sucked out of financial markets. And that is likely to continue into 2019, whether the White House likes it or not. Because at some stage, the Fed's balance sheet had to be brought back to normalcy. Now, we'll have to see what is that normalcy and when will the retreat stop. But it looks like there's more to come, because we just heard from the ECB 2 weeks ago that they've stopped buying bonds. So, and at some stage, the Bank of Japan and the Bank of England will also join this rally. So global liquidity tightening is something that asset markets will have to accept. And that means, asset prices in general will have to correct downwards.
But Pramod, given there will be liquidity tightening and slower global growth will impact Indian equities to a certain extent, but do you think that our preference will probably stay high on the radar because of crude prices, given the caveat that crude prices will remain within a sustainable range?
Absolutely. That's a big caveat. I don't think any of us could have predicted that crude prices will be in the 50s barely 2 months ago. But assuming that they stay within this range, I think it's a huge, huge positive for India, both fundamentally as well as from a currency standpoint, because current account deficit can be kept in check, and that becomes an attraction for FPI investors as well. So what could have been a double whammy in the form of a current account deficit and capital outflows suddenly becomes a positive trend for India. And India should stand out amidst this sort of correction in global markets when everything is painted with the same brush.
Okay. How much can the standout be? Crude is a positive. If it continues this way, will you pencil in rate cuts? There is a generous liquidity coming from the Reserve Bank. Putting all this together, what are you expecting 2019 to be? Will it be a green year at all? The 2018 year has been a washout. I think we are going to end with on a no loss, no profit basis. What might 2019 look like?
No, I think, from a liquidity standpoint, we clear the RBI, even, under the previous governor, was fairly benign as far as the local liquidity was concerned. Rate cuts might be taking it a bit too far, because we'll have to watch the next 6 months in terms of policy action ahead of the general elections. Often ahead of general elections, you see, further money pumped in and inflation beginning to look up. Fuel inflation will be curtailed if assuming crude prices stay where they are. But I guess the biggest surprise has been around the food inflation. Despite the MSP policy, food inflation has not just remained benign, it's in fact turned negative. And that can be a big driver of inflation if the MSP action on the ground picks up between now and the general election. And that's something that the RBI will watch out for before looking at rate action. At best, maybe there are no further hikes, but to look for a rate cut will be far-fetched, in my view, as of now. Yeah. But in terms of the market reaction for 2019, it's always difficult to predict at the market level, but certain sectors and certain stocks will definitely be looking positive. And for bottom-up stock pickers, given this tailwind from crude, you can look at specific stocks which will recover in terms of earnings, and those would be great buying opportunities in 2019.
So, Pramod, just leave us with a late Christmas gift then. Tell us these sectors which would probably look like a good investment top-down onwards next year, and maybe even stocks if you can talk about it.
I think private sector banks clearly will benefit significantly, not just because they're taking market share from NBFCs, but also in terms of any potential capex recoveries. Like we've seen the recent past, some of the sectors are inching up in terms of utilization levels. So maybe on the other side of elections, you will see a capex recovery, and the best play on that should be the well-capitalized private sector banks with strong CASA. And the other sector, I guess, is consumption, which is always positive, but in an election year, consumer-oriented companies which have input costs exposed to crude or crude derivatives should again benefit from lower crude prices in terms of margin expansion alongside the healthy top-line growth that we see. So I guess we're not talking anything different. Private sector banks and consumer sectors will be sectors to watch out for in 2019 as well.
All right, Pramod, thanks very much for joining in. So 2019 liquidity tightening, that's all we're going to be hearing about for most of the year. So watch out for that and how the asset classes react to it. Up next, Nigel is here to take us through the cues that are coming in from the F&O space. Nigel.
Well, Sumaira, if you look at the Dow futures, then that's indicating a cut of around 30 to 40 points to kickstart trade. Early morning, the Dow futures were down more than 150 points. So that could explain some part of the recovery. But if you're looking at the option space on the whole, then you keep an eye out on a couple of marks. One is the intraday low, the 10,535 mark. That's from where we bounced up. So that becomes the first stop loss, and the bulls at least will try to defend that particular mark. Importantly, we already broke the 50 DMA, and we're trading below that level. So technically, it's not looking very, very good. 10,600 call, aggressive writing, more than 20 lakh shares being added there. The 10,700 call as well has added a fair amount of shares, telling you that the bears feel that they can definitely defend the 10,600, 10,650 odd mark. On the downside, the 10,500 level becomes extremely crucial. We have expiry tomorrow. The premiums are around 35 rupees. So that's telling you that the 10,500 put, whoever's writing that particular strike, they're expecting the 10,465 mark to hold out. So 10,500 becomes extremely crucial. But otherwise, the bulls, they're throwing in the towel, at least those who had written some puts, the 10,700 put, that's telling you the story. Big unwinding being seen over there, close to around 8 lakh shares getting unwound out there. All eyes on the 10,535 mark, today's low, and the 10,500 level. That's the important level because that's where the maximum open interest is there on the put side. Back to you all.
Okay, all right, Nigel. Thanks very much for that. In fact, it is expiry tomorrow, and it hasn't been a great December expiry to end the year, Sumaira. We've lost around 2.5% plus on the Nifty this series, and the mid-cap index is absolutely flat, so a bit of an relative outperformance, you'd have to say. But on a quick programming note, reminder, CNBC TV 18 has launched a special initiative in partnership with the National Stock Exchange. Every month, we will tell you how investing in stock markets or equities makes one financially disciplined. This is a monthly program to inform and educate investors about smart investing and enabling the journey to wealth creation. Catch our special coverage all through the day only on CNBC TV 18.
All right, for now, we'll take a quick break. Up next, some commodity cues and trading strategies are lined up with Navneet Damani of Motilal Oswal Commodities. Stay tuned.